second panel, you can see how I'm paying attention to things. First of all, I want to thank the panel for being so courteous toward us to wait over and to this hour. We'll try and move it along as quickly as possible. We sent all the whips out to alert the members to get over here or suffer penalty of death, and that's possible. We have your written statements that will be made part of the record. You each will be recognized for 5 minutes summary of your testimony. And as you may have gathered, I'm a little on the lenient side, but sometimes at this hour of the day, even my patience get tried and I get to be nasty. So if I whip you down, I'll apologize ahead of time, but I'll still whip you down. First, we're going to have Mr. Jeff Mahoney, General Counsel of the Council of Institutional Investors. Mr. Mahoney.
Chairman Kojarski and members of the subcommittee, good afternoon. I'm Jeff Mahoney, General Counsel of the Council of Institutional Investors. It's a real honor for me to appear before you today on behalf of the Council. I have brief prepared remarks and would respectfully request that the full text of my statement and all supporting materials be entered into the public record. The Council is a not-for-profit association of more than 130 public, corporate, and labor pension funds with assets exceeding $3 trillion. Our members are obviously quite diverse and include the Pennsylvania State Employees Retirement System, Johnson & Johnson Corporation, and the IUE CWA Union Pension Fund. Council members are generally long-term share owners responsible for safeguarding assets used to fund the pension benefits of millions of participants and beneficiaries throughout the country. Since the average council member invests approximately 60% of its entire pension portfolio in U.S. stocks and bonds, issues related to U.S. corporate governance, including issues related to financial accounting and reporting, are of great interest to our members. As an initial matter, the Council's policies reflect our members' views that, first, the goal of financial accounting and reporting and accounting standard setters should be to satisfy the information needs of investors, the key consumers of financial reports. And second, the needs of investors are most likely to be met if the responsibility to promulgate accounting standards resides with an independent private sector organization that employs a thorough public due process that actively solicits and gives preeminence to the views of investors. Although we believe that the current U.S. accounting standard setting structure and process can and should be further improved, we would strongly oppose any legislative or regulatory effort that would diminish the independence of accounting standard setting and provide certain industries with direct or indirect control over the outcome of that process. In our opinion, we must avoid changes to the accounting standard setting that may cater to the short-term self-interests of a particular industry to the detriment of the short and long-term interests of investors and other market participants. Second, we generally agree with the findings of the United States Securities Exchange Commission's recent report and recommendations to Congress that have been discussed earlier today. More specifically, we agree with the Commission's findings that existing fair value accounting standards for financial instruments, if properly applied, increase the quality of information provided to investors about those contracts by better reflecting, and again, if it's properly applied, by better reflecting the current economic reality. We note that the Commission's findings are generally supported by a July 2008 Council Commission white paper entitled Fair Value Accounting, Understanding the Issues Raised by the Credit Crunch. That white paper is included as an attachment to the full text of my testimony for your information and review. Consistent with the Commission's findings, the white paper concludes that because of its timeliness and relevance, fair value accounting, again, if it's appropriately applied, reduces uncertainty over time much more quickly than other existing accounting measurement approaches. As a result, fair value accounting has the ability to assist in actually mitigating the duration of a financial crisis. Many financial experts agree that Japan's failure to embrace fair value accounting for the financial assets of its troubled financial institutions back in the 1990s unnecessarily exacerbated that country's economic woes for an entire decade. Finally, we believe that the most appropriate approach to addressing concerns about the pro-cyclical effects of fair value accounting is not to change the accounting standards that provide information to investors, but instead to encourage the U.S. financial institution regulators to exercise their authority, which Mr. Bailey said today that they do have, and which they have done on a number of occasions in the past, to modify, if they deem necessary, fair value accounting or other accounting principles for regulatory capital purposes. That approach that I just described allows the regulators to appropriately address their responsibilities to foster safety and soundness and financial stability of U.S. financial institutions without further lowering investor confidence by denying investors the information they need to make economic decisions. Mr. Chairman, when I receive my quarterly 401k statement, I see current economic reality in that statement. Those who invest in U.S. financial institutions and other U.S. companies deserve to see the same economic reality. Fair value accounting, though it has some flaws and is not perfect, but fair value accounting for financial instruments gets investors closer to that goal. In closing, we look forward to continuing to work cooperatively with the Financial Accounting Standards Board, the Securities Exchange Commission, this subcommittee, and all other interested parties to further improve financial accounting and reporting. Our aim is always to provide constructive input and support to ensure that financial reporting continues to evolve to better serve the needs and demands of U.S. investors, the U.S. capital markets, and the U.S. economy. Thank you, Mr. Chairman, again for inviting me to participate at this hearing, and I look forward to responding to your questions.
Thank you, Mr. Mahoney. Don't want to miss that. And the next we'll have Ms. Cindy Fornelli, Executive Director of the Center for Audit Quality. Ms. Fornelli.
Thank you, and good afternoon, Chairman Kondrasky and members of the subcommittee. I am Cindy Fornelli, the Executive Director of the Center for Audit Quality, and you too have my written testimony. So what I would like to do this afternoon is reiterate 3 critical points that have already been made this afternoon, or that were made this morning, which I suppose is a hazard of being on the second panel. First of all, for over 30 years, fair value accounting has contributed to increased transparency in financial reporting. Fair values application has room for improvement, but as the recently congressionally mandated SEC study confirms, loan losses and runs on the bank caused the current financial crisis, not fair value accounting. Therefore, suspending fair value accounting will not fix the problem, and as the SEC also noted, could further erode investor confidence. Thus far, Congress, regulators, and standard setters wisely have resisted pressure to abandon the basic principles of fair value accounting, which is to provide current financial information to investors. To suddenly stop reporting current values, especially in a time of crisis, could make matters worse by adding uncertainty to investors. Second, the challenges faced by financial institutions in meeting their capital requirements are critical and are legitimate policy issues for prudential regulators. But dealing with capital adequacy concerns by suspending or significantly altering fair value accounting would only serve to obscure current realities, further undermine investor confidence, and prolong the current crisis. Investors need to know the current values of loan and securities in order to make rational investment decisions. Regulators need to know the current values of loans and securities in order to make rational policy decisions. The application of fair value accounting standards can and should be improved, and as quickly as possible. However, as we heard this morning from Deputy Comptroller Bailey, banking regulators have the authority to determine whether or how current valuations affect capital requirements and make adjustments accordingly. While accounting standard setters need to improve the application of their standards, prudential regulators should consider improving application of their capital requirements. Third, while we vigorously support the continued use of fair value measurements, we believe there are ways to improve the application of those measurements. The Center for Audit Quality put forward a number of specific recommendations in its November comment letter to the SEC during the SEC's fair value study, including, number 1, how to value an asset in a time of changing, disrupted, or illiquid market conditions, such as we have now. Number 2, how fair value measurements might differ for different types of assets and liabilities under various market conditions. Number 3, how to achieve clearer and more transparent disclosures about the assumptions and methods applied in the fair value measurement process, as well as the conditions present in a particular market. And number 4, how companies recognize periodic changes related to credit losses versus other types of losses in income in their financial statements to address the temporary impairment issue that was discussed at length this morning. Recognition of non-credit related investment losses outside of income would help address assertions that fair value accounting forces institutions to use overly pessimistic market prices to value their assets and liabilities. The CAQ and the audit profession stand ready to assist in the application of these improvements once they are in place. The bottom line is we all want swift and meaningful action to address the current crisis. But as we respond to the crisis, we should remain true to fundamental market principles. Investor confidence in the reliability and transparency of financial reporting is critical to our financial system's long-term well-being. We must pursue only those solutions that do not put that confidence at risk, and there are such solutions on the table, as we've discussed this morning. Thank you for the opportunity to share my views, and I'm happy to answer questions.
Thank you very much, Ms. Finelli. Next, we'll have Mr. Thomas Bailey, Chairman of the Pennsylvania Association of Community Bankers and President and CEO of Brentwood Bank. Mr. Bailey.
Thank you, Chairman Konjorski. Thank you, Chairman Konjorski, Member Garrett, and members of the subcommittee. I appreciate the opportunity to provide a community banker's perspective on the current application of mark-to-market accounting. I am Chairman of the Pennsylvania Association of Community Bankers and also testifying today on behalf of the Independent Community Bankers of America. Chairman Konjorski, PACB and ICBA salute your leadership in calling this important hearing. These rules are exasperating the financial crisis. As President and CEO of Brentwood Bank, a $450 million asset bank serving the South Hills of Pittsburgh, I can tell you about the impact of these accounting rules are having on my marketplace. Through the 9 months ended December 31st, 2008, Brentwood Bank has granted $64 million in business loans, mortgages, and consumer loans, while continuing to maintain a delinquent loan asset ratio of less than 0.25%. Brentwood Bank has taken an approximately a $2 million OTTI charge, which represents a lost opportunity to finance $20 million in loans based on a 10% equity requirement. This represents 30% of the loans we have made in the past 9 months. The application of mark-to-market is frozen markets in the heart is the heart of the problem. When these rules were developed, this unprecedented situation could not have been imagined. FASB has not taken action, and the problem is getting worse. While a total suspension of mark-to-market accounting is appealing, we know that there are many concerns about how the capital markets may respond, which is why we offer an alternative approach which conforms with existing accounting rules. PACB and ICBA support transparency of financial statements. Current mark-to-market accounting rules hinder transparency and distort the true condition of financial institutions holding mortgage-backed securities, particularly private label securities and other debt securities. Fair value applications in an illiquid market result in a disproportionately greater write-down than anticipated credit or economic losses. Here's a real-life example which can be found on page 3 of my statement. An institution holding private label mortgage-backed securities with an initial carrying value of $125 million is represented in bar graph 1. An analysis of future cash flow concludes the securities would suffer a future loss of about $16.7 million in a rigorous process described in my written statement. However, when fair value is developed in today's illiquid market, that institution had to take a $58.9 million charge, over 3 times as much as the true economic loss. What we heard this morning will not help this situation. The January guidance did not solve the problem. While this is only one example, there are over $400 billion of other securities held by the nation's insured financial institutions that could meet a similar fate. These statistics don't include debt securities held in other large financial services businesses, such as the insurance industry. Financial institutions are concerned about the procyclical nature of mark-to-market standards in the current environment. They are extremely hesitant to risk purchasing assets that could result in future material write-downs if an impaired credit loss may occur. Thus, mark-to-market creates a self-fulfilling downward spiral for the prices of MBS, other asset-backed, and debt securities. OTTI rules raise the specter of future write-downs that could further weaken capital positions. This could contribute to the hoarding of capital at many banks. This prudent reaction to guard against future accounting-driven losses likely inhibits the flow of badly needed credit. OTTI rules also have inadvertently thwart the government's extraordinary efforts to replenish the financial industry's capital. This is a paper loss and does not reflect economic reality. We do not believe Congress should write accounting standards. However, continued application of this accounting standard based on valuation derived from a dysfunctional market only serve to compound the current systemic risk. Therefore, we propose Congress must hold FASB accountable and ask the SEC and FASB to apply existing accounting rules that apply to loans held in portfolio to asset-backed and other securities. The determination of whether OTTI exists, as well as the magnitude of the loss recorded, should be based on rigorous credit analysis appropriate to the characteristics of the security. This change would not hinder transparency and would actually improve comparability and consistency. Our proposal is similar to international accounting standards rules that apply FAS 5 and FAS 114, like treatment of OTTI of MBS, and permit the recognition of future gains against recorded OTTI losses. Mr. Chairman, this hearing and the recent legislation introduced by your colleague, Representative Perlmutter, are crucial steps in breaking the logjam associated with mark-to-market. All of the subcommittee members must be publicly commended. I stand ready to answer any questions.
Thank you very much, Mr. Bailey. And next, we'll hear from Mr. Lee Cotton, past president of the Commercial Mortgage Securitization Association. Mr.
Good morning, or good afternoon. We did start this morning. We would like to thank you and Representative Garrett for having us here today and for your leadership in this process. As you said, I'm Lee Cotton. I'm the past president of the Commercial Mortgage Securities Association. CMSA, as we are called, represents all of the players in the commercial mortgage securities business, from issuers to servicers to people who underwrite loans to people who sell loans. It is a broad consortium of folks. These participants have come together over the last 15 years to try to create a very transparent market, and in that regard, we are proud of the investor reporting package that we have put together, which provides clear, concise data on all of the securities that have been issued. To that end, you can go find a mortgage in your districts, and you can understand what's going on in that mortgage. From that point of view, what we are very worried about is the application of fair market or fair value accounting. By application, I mean the practical application. We urge you, as we saw you do this morning, to address this issue, particularly with FASB. Today, as you well know, there is no market for commercial mortgages. Same as Mr. Bailey's problem. No investors are buying securities, which provides no liquidity to the market. It's not purely an issue of the banks or regulated banks. It's an issue of investors' willingness to buy securities backed by commercial mortgages. In 2007, over $240 billion in CMBS was issued. In 2008, $13 billion, and then for the last 9 months, $0. As we approach the next 18 months with billions of dollars, hundreds of billions of dollars of commercial mortgages coming due, there is really at this point no source for those. As Treasury Secretary Geithner said, no economic recovery plan will be successful until it restarts the securitization markets. We believe that these rules as applied are going to help restart that market. I do have one concern with FASB, and that is they are seriously considering abandoning the vehicle through which securitization can be done through FAS 140 and FIN 46. That would be taking away with one hand what you so hard are working to get back on the other. The issue this morning that was discussed about pro-cyclical activity is the one that I think we can focus on for a minute, and then we'll talk about our recommendations. If an asset is sold, and the discussion was held earlier this morning about a willing seller, willing buyer, there are buyers who are forced to sell because they've been marked. When that sale takes place, then there's a cash transaction that you can hang your hat on, and there's the pricing has been established. But that seller was not necessarily a willing seller. He or she was in a position they had to sell by virtue of being marked down. And that marked down position crystallizes a loss, which then further exacerbates as it works through the system. That's the problem I think that we all here have. We are not against fair value accounting. We are not against transparency. As an organization, as I said before, we've worked very hard to create transparency. But as it is interpreted today and applied, it falls very, very short in non-functioning or illiquid markets. And that's the concern that we have. The guidance that you all asked for this morning from FASB and from the others in the panel this morning will be very, very helpful to our industry and other financial industries as they approach this issue. CMBS as a whole has had a very, very strong function and a default history. Less than 50 basis points of defaults for the last 2 or 3 years. We're now all the way up to 125 basis points. There's no question that will increase, but it does not increase to the level that the pricing in the marketplace is presently showing us. The issue is really how you set the price, and how you set the price can be done with hard work, credit analysis, understand the cash flows available in the assets, and come to a conclusion. Not just go ask for 3 bids from 3 bidders who are unwilling to own those assets, and then assume that that's the value. And I heard this morning FASB say that there are these procedures that you can go through, and the third one is to go and do the hard work, but the accountants have not yet gotten to the hard work part. I'm getting a sum up sign, so I'm going to speed up. We are urging clear and strong guidance, as I've said. That guidance needs to give, or as someone said this morning, empower the accountants to be able to go to the third level and actually do the credit work, actually understand the assets, understand the loans below the securities. The guidance needs to be clear and specific in the non-functioning markets. Define what a non-functioning market is, and then help the accountants do their job. We're not picking on the accountants, but help them do their job. And finally, the policymakers must recognize the difference, as was discussed earlier today, of impairment caused by credit, true losses taken, and impairment caused by the market dysfunction and the volatility and the illiquidity in the marketplace. We are not opposed to fair value. We believe that on paper it works terrifically, but in practice, particularly today in an illiquid market, it's very, very difficult to undertake. Until these issues are addressed, we think there will be a frozen credit market in the markets that I represent, which is commercial mortgages, and other markets as well. I thank you for your time, and I'm willing to take questions.
Thank you very much, Mr. Cotton. And now next we'll hear from Ms. Tanya Beater, Chairman of the SBCC Group. Ms. Beater.
Chairman Kanjorski, Ranking Member Garrett, and other members of the subcommittee, thank you for inviting me to testify today. My name is Tanya Beater. I am Chairman of SBCC Group. We are an independent advisory firm. We assist firms who are bleeding money, and we help firms to seize opportunities in the markets as well. The firm was founded in 1987, has a broad array of clients. In the current crisis, we have advised on multi-billion-dollar liquidity runs, on hundreds of billions of dollars worth of CDOs, and for numerous people who are experiencing problems in the current markets. This is a period of significant global recession and prolonged mayhem in the markets. In fact, if there's a light at the end of the tunnel, it may well be an oncoming train. An important aspect of the financial health of this nation is the quality and the integrity of financial information, and I applaud this committee's focus on this important topic of mark-to-market. I would like to submit my written testimony to the record and now summarize my testimony with the following statement. Mark-to-market accounting should not be thrown out. In normal markets, unless there is manipulation, mark-to-market represents fair value well. However, in distressed markets where only fire sales are taking place, and in over-fueled markets, often mark-to-market is based only upon one price in such markets, marking to an independent third-party model may be a better approximation for fair value. I have 4 recommendations for the subcommittee's consideration. The first is that the committee should encourage standard setters and regulators to provide users with urgent help to distinguish between going concern and liquidation valuation in an illiquid market. Do not abandon mark-to-market, but allow for additional measures, such as mark-to-model from independent sources. Additional disclosure should be made so that it is clear when different approaches are employed. We should also distinguish in overheated markets when different approaches are taken. Remember, in just about every financial disaster we have had, and certainly all of those that I've assisted firms with, profits typically precede losses. And there were numerous profits in the CDO space and in the credit default swap space, among other credit-linked areas before we got into these problems. The second recommendation is that there should be a more flexible approach to defining fair value. None of the single measures are the best choice across superheated, normal, or distressed market conditions. The subcommittee should promote more supervisory activity and provide the necessary tools to the supervisors, both analytic and monetary tools, to keep up with the firms they supervise. I would note that in most cases, this does not mean more regulation, but more effective regulation. However, in a few cases, and in particular, I would highlight things like the work I did in Orange County and Florida's local government investment pool, the unregulated investment pools could stand additional oversight. My third recommendation is to encourage the standard setters and the regulators to implement multiple measures and to promote their collective value. A prominent feature of the gains and the losses in the current market, both on the way up and on the way down, was tremendous oversimplification. The final recommendation that I have is that in order to reduce the procyclical impact of the current approach, and I do believe it is quite procyclical, it's not just a question of the mark-to-market accounting. I also believe it's heavily fueled by the fact that everyone uses the same approach. We saw during the long-term capital management problems that numerous people doing the same things create a herding effect and a common reaction. If the same accounting is used for all firms, we also risk a situation where reactions are exactly the same, both on heavily fueled markets and on markets that are in trouble. I will close just by saying that one of the things that came up this morning is how do you do this in 3 weeks, which is the deadline that was tossed out. And I would just add an end note that one of the things that makes it very difficult for firms to operate quickly are the liability issues that surround the market. And if I fear that if firms are forced without addressing that issue to pick a price to put on instruments, that a safe price will be 3 cents because you can only get sued for 3 cents. So I think that needs to be in the forefront alongside of the need to address things in a speedy fashion. Thank you very much, and I look forward to your questions.
Thank you, Ms. Beater. And now Mr. McTier, Distinguished Fellow from the National Center for Policy Analysis, for 5 minutes. Thank you, sir.
When I moved to Texas in 1991 to become president of the Federal Reserve Bank there, someone gave me a little book of Texas wisdom titled, "Don't Squat with Your Spurs On." And one of the most useful jewels out of that book has turned out to be, no matter who says what, if it don't make sense, don't believe it. Well, what's been going on with mark-to-market accounting just doesn't make sense to me. Much of our recent wealth destruction has resulted from slavish adherence to an accounting dogma that never should have been applied to banks and other regulated financial intermediaries in the first place. Thousands of banks, thrifts, insurance companies, and credit unions who had absolutely nothing to do with making or securitizing subprime loans are victims, not villains. They invested in mortgage-backed securities because they thought they were safe and liquid, as indicated by their AAA rating. When subprime mortgages in the pools began defaulting at a higher rate, the market for the bonds dried up. Yet the rigid application of mark-to-market rules enforced by regulators and gun-shy internal and external auditors forced drastic write-downs even when their owners were both willing and able to hold the securities until the market improved or even hold them to maturity if necessary. Even though the bonds weren't traded, most of the underlying mortgages were still generating income and still are. The larger tragedy comes not from the write-downs per se, but from the resulting decline, dollar for dollar, in regulatory capital. Hypothetical or potential losses in securities result in actual or real losses of capital if the securities were in an account labeled securities for sale rather than securities held to maturity. It would be a simple matter to change the labels, but contrary to what I heard this morning, I'm told that the accounting rules don't allow it. Fixing that would be an easy interim step. A closely related question is whether the impairment in individual mortgages is classified as temporary or other than temporary, in which case they must be written off. Logic would suggest, at least, that any excess of capital written off that way could be added back to capital or accreted if the original judgment is proved too pessimistic. It's my understanding that most of the regulators concur with this, but are hesitant to allow it because it has to be reported back to the Congress if they do. Reassurance on that score from you would be helpful. They do have the authority, I'm told. They just need a nudge. I've heard it said that mark-to-market was considered fine for banks until the market turned against them. This is not entirely true. Chairman Greenspan wrote a 4-page single-space letter to the SEC urging them not to apply mark-to-market to commercial banks because their business model is not that of a trader, but involves holding assets on their balance sheet. His letter is dated November 1st, 1990. A little later, in 1992, Treasury Secretary Brady wrote a similar letter to the SEC. And in 1992, so did the chairman of the FDIC. Now we fast forward to 2009 when Paul Volcker, speaking as chairman of the group of 30 experts, released the results of their study of the financial crisis. His recommendation number 12 says, A, fair value accounting principles and standards should be reevaluated with a view to developing more realistic guidelines for dealing with less liquid instruments in distressed markets. And B, the tension between business purposes served by regulated financial institutions that intermediate credit and liquidity risk and the interest of investors and creditors should be resolved by development of principle-based standards that better reflect the business model of these institutions. If a mortgage pool collateralizing a security becomes impaired, the negative impact is multiplied. For example, if a bank buys a bond with 1,000 underlying mortgages, and a few of these mortgages become other than temporarily impaired, the bank has to write down and lose regulatory capital on the whole bond, not just on the impaired mortgages. And I believe one of you cited this morning the example of the Home Loan Bank of Seattle, which expects ultimately to have a $12 million loss on a portfolio that it was required to write down by $304 million. Now, you can't unscramble an egg, but if the bank that had the 1,000 mortgages on its book as a mortgage-backed security could have the same mortgages on its books individually, the write-downs could be much more modest. While the original markdowns may not be justified, they do tend to be self-fulfilling. The resulting loss of capital may attract increased supervisory attention, which perversely may lead to higher capital requirements, just as capital is becoming scarce. The bank's worsened condition may bring higher FDIC deposit insurance premiums as well. Restrictions on growth may then follow so that the weakened banks can't try to grow out of their problems. The motive here is to preserve and protect the insurance fund. The banks, after being restricted in their accumulation of capital reserves during the good times, have their requirements increased when they can afford it least. The FDIC, after having to keep its premiums low during the good times, has to raise them during the bad times. In the present case, an alternative needs to be found. This whole perverse pro-cyclical sequence of events started in my example with unnecessarily rigid application of mark-to-market accounting.
Mr. McTier,
One more
if you
point.
could wrap up.
Okay. Well, I'll just say this. I started off with a little homily out of the book. Another one is, if you keep doing what you're doing, you keep getting what you're getting. Thank you, sir.
Thank you, Mr. McTier. And now our final panel member, the Honorable William Isaac, Chairman of the Secura Group of LECG. Mr. Isaac, for 5 minutes.
Thank you. I really want to commend the committee for this hearing, particularly this morning. I really enjoyed it. It's a ray of hope that somebody finally is focusing on these issues and trying to get FASB and the SEC to do something. I raised this issue about a year ago, and I've been on it ever since. And I'm just appalled that we've spent $700 billion of TARP money. The FDIC is asking for another $500 billion. We're taking all this taxpayer money when the SEC and FASB are sitting on their hands, not addressing a very fundamental problem in this banking crisis. And I'm incensed, and I'm glad you are. I just really, I felt better this morning than I've felt for a year, just watching this committee do its work, and I congratulate you. And I hope you hold their feet to the fire. I hope on April 1, if they haven't gotten this thing fixed, that you will do what you've promised to do, that you'll legislate this issue, because they just have been terribly negligent and arrogant not to deal with this issue. If I sound angry, it's because I am. I'm very angry. I was chairman of the FDIC in the banking crisis in the 1980s, and I can tell you that it was a far more severe banking and economic problem back then than we started out with here. Now, we're approaching that one, but it didn't start out that way. It didn't need to be that way. The mark-to-market accounting is a very, very serious problem. In the 1980s, we had a 21.5% prime rate. We had a severe recession with the unemployment rate reaching a neighborhood of 11%. We had massive insolvencies in the thrift industries, the S&Ls and the savings banks. We had money center banks that were loaded to their gills with third world debt. We could have marked all of those to insolvency if we had wanted to play by today's rules. We would have. And we would have created a depression and a crisis where we wouldn't be sitting here talking today, because we'd probably still be in the recession or the depression. We had real estate problems all over the country. We had major banks. Continental Illinois, the nation's 7th largest bank, went down. We had regional banks all over the country, including 9 out of the 10 largest banks in Texas, fail. There wasn't any forbearance back there. We didn't have to deal with mark-to-market accounting. We tried to clean up the problems in an orderly way, but we'd handled 3,000 bank failures. And I hear my colleagues down at the other end of the table talking about Japan. Japan is totally irrelevant. They didn't have fair value accounting to apply. They didn't ignore fair value accounting. They didn't have it. And the U.S. didn't have it in the 1980s. We didn't need it. We dealt with our problems. Japan didn't. But fair value is not a part of that discussion. To say that we've had fair value accounting for 30 years is not the truth. We have not had fair value accounting for 30 years. We may have had some form of it on trading accounts, but not the kind of fair value accounting that they have here. I want to talk about the fact that fair value accounting, or I call it mark-to-market accounting, because there's nothing fair about this accounting. It's bad accounting. But we've destroyed $500 billion of bank capital in the past year through this mark-to-market accounting. That's $5 trillion of lending capacity that has been crushed by FASB and the SEC. It has led to unemployment, loss of homes by millions of people. The harm is just enormous. And it's not as if they went into this not without warning. In 1938, President Roosevelt and the Secretary of the Treasury and the bank regulators got rid of mark-to-market accounting because it was holding us in a downward spiral. We couldn't get out of the Depression, and so they abolished it. In 1990, when the SEC started down this path of having mark-to-market accounting again, they were warned by, as Bob said, by the Secretary of the Treasury, the Chairman of the Fed, the Chairman of the FDIC, don't do it. You're going to have major problems if you do. And I think that the Secretary of the Treasury was particularly prescient with his comments. It was Nicholas Brady, and let me read him. This is a March 24, 1992 letter to the Chairman of FASB. They didn't pay any more attention back then than they do now. Mark-to-market could result in more intense and frequent credit crunches, since a temporary dip in asset prices would result in immediate reductions in bank capital and an inevitable retrenchment in bank lending capacity. Finally, it is inappropriate to apply mark-to-market accounting to only a portion of a bank's balance sheet, as would the FASB proposal. This could exacerbate the public's perception of systemic instability even when the industry's underlying businesses are solid. I came across this last night. I'd forgotten about it, but I appeared on an FDIC panel on the banking crisis of the 1980s, and the lessons learned. This was in January 1977. I found this online. 97. Paul Volcker and I were both on this panel. They asked us about mark-to-market accounting. 1997, not in the context of today's crisis. Paul Volcker said this: "I think pushed to the extreme, mark-to-market is nonsense for a bank. The idea that we have to be so precise about mark-to-market accounting for an institution that is supposed to take liquid funds and transform it into something longer while we tolerate enormous uncertainties in accounting on other parts of the balance sheet and in industry generally doesn't make sense to me." Here's what I said. If we had mark-to-market accounting back in that period, in the 1980s, and if we had wanted to, we could have closed every savings bank in the country at a cost to the FDIC of tens of billions of dollars. That's what the numbers were. We had documented it in the Savings Bank Task Force. So we could have shut them all down, mark-to-market, spent tens of billions of dollars. I say the social cost of that would have been inordinately high. I think doing everything by the numbers without discretion is a mistake. People keep on pushing for market-to-market accounting, prompt corrective action, and the like. And the next time we have an ag bank crisis or a savings bank crisis or an LDC debt crisis, I think we're going to regret that we have those laws on our books. I think it's going to tie the regulators' hands in a way that's going to precipitate a crisis that could otherwise be avoided. Don't let up on these guys. Go after them. If April 1 comes and they haven't fixed this, then nail them, please. Thank you.
Thank you, Mr. Isaac. And I'll begin by asking a few questions. And I'd start with you, sir. Today, what would you have this panel do, other than hold those guys' feet to the fire? If we were to change the law today, what would you seek?
Enshrine yourselves for this hearing today. I mean, I think it's just fabulous. I really mean that. It's a ray of hope in a really dire economic situation. I'm all for good accounting, and I want fair accounting, not the kind of fair accounting they want, the kind that just looks at a computer screen, which is where the prices are dictated by some short seller who thrives on chaos. I want somebody to go in and do some economic analysis on these assets, and nobody's doing that now. I think the accountants need to get in there, roll up their sleeves, and start looking at the cash flows.
All right, but I want to be the devil's advocate here. We listened to the SEC, FASB. One of the comments, sort of tangential comments, was that the banking regulators have the discretion today. Why aren't they exercising some discretion to not just blindly apply a principle or a standard that doesn't seem to work in a disorderly market like we have today?
There's a lack of confidence in the system right now because nobody knows what's going on. All we know is short sellers and others, speculators, don't want to buy this stuff, and so they mark it way down, and we say, okay, that's the price. The banks say, no, it isn't. It really isn't the price. I have a chart in my testimony I do hope you'll look at, because it gives a really good example of what's going on. I think that if you have a bank announce that they have let's say a $30 billion, Gotham Bank announces a $30 billion mark-to-market loss, and they report that under the mark-to-market rules. And then the bank regulators come along and say, well, okay, there is that loss, but you really don't have to count it for bank capital purposes. I don't think we solve the problem. We still have people saying, what's the price? What's the right number? The regulators, the FASB and the SEC are saying there's a $30 billion loss there, which there really isn't. But the bank regulators are saying, well, you don't have to count it. We'll give you forbearance. And that doesn't give people confidence in our system. One thing that you knew in the 1980s is when the bank regulators came in and did an examination, and that they were trying their best to mark the portfolio to its actual economic value. And that's what we've got to restore, is we ought to be dealing with true economic value through accountants going in and doing their job and bank examiners going in and doing their jobs. And it doesn't do any good to have FASB pretending that there's a $30 billion loss there isn't, and the regulator saying, well, we're not going to honor your pretend number.
Let me ask Ms. Fernelli, what would you have us do today? I mean, you've heard a lot of testimony today. You obviously have heard from us that we're not happy about what's going on here, because you're focused on investors. We've got to focus on the broader field of depositors and taxpayers on top of that. So what would you have us do?
I would have you do what I think you've heard the majority of your panelists, both this morning and this afternoon, say, and that is a two-pronged approach. One is on the regulatory capital side with the banking regulators, as Mr. Bailey outlined earlier this morning, and then the other is addressing these application problems with fair value accounting, both in the proposals that FASB talked about with how to better apply or give better guidance as to how to apply fair valuations in an illiquid or a highly distressed market, and also on the OTTI side that we also heard about this morning, which I don't think is a current FASB proposal. So I think if you attack the problem from those two prongs, I think that's what you should do. Push us to do those two things.
Anybody else have a specific suggestion? And then I'll turn the mic over to the ranking member. Thank you all very much, and I'll yield now to Mr. Garrett. Oh, to Mr. Neugebauer.
Thank you, Mr. Chairman. I think as we go down this discussion that we've heard today, I think one of the thoughts that comes to my mind is it's like going to the doctor, and the doctor says, you have cancer. And you go home, and your wife says, well, how was your doctor's appointment? And said, well, fine. We said, what did he say? He said, oh, he said he had a cold. And that's not full disclosure. Some of our financial institutions, not all of them, but some of them have some very cancerous assets in their portfolio. And some of these are very highly leveraged institutions. And their ability to manipulate their valuation of those assets can materially impact the value that the investment community might place on that institution. While I understand there are other institutions that are holding assets, and they may be of a different quality, I think one of the problems with the whole subprime and all of the securitized transactions that we've done, they're very complex, they're layered, and very hard to identify exactly what is the actual risk within those portfolios. So one of the things that I think has to happen here is that we have to make sure that we don't lower the standards so that we can allow institutions that maybe shouldn't continue to be able to operate or shouldn't be operating somehow to give them a free pass while at the same time making sure that we are, the investment community is rewarding those companies out there that are actually managing their business in an appropriate way. The question I have, I think, Mr. Bailey, you mentioned that you had taken a write-down, but do you have a model that you use to evaluate your mortgage portfolio to determine what the value of your portfolio is?
Yes, sir. I guess we follow the FASB guidelines right now, but in that instance, we're looking at a mortgage security that is basically has some credit issues in it, and as we do a rigid credit analysis, we say, okay, using the example, you pay $1 for it, there are credit issues. It may be only worth 90 cents, but because you have to go out and get a market price for it, and no one is in the market these days, and they quote you 60 cents, you're taking a charge of 30 more cents than the difference between the 90 and the 60.
Are you using an internal model, or are you using a recognized model?
We're doing the analysis, but then the FASB guidelines, as I understand them, would require you to write down to the market value.
Yeah, but I want to be clear, you're using FASB guidelines, but you're using your own model.
Correct.
Is that correct?
That's correct.
And so another bank that down the street might be your competitor may believe that he is following the FASB guidelines and he's using his model or her model. That could be a different valuation. And is that correct?
That is correct.
Yeah. And so then how do I know then what the condition, if I've got both banks side by side, how do I know which is the healthier bank?
I'm having the same problem, Congressman. I guess one of the examples is we rode down to Washington. We were looking at talking about different banks and their financial statements that were out. All big accounting firms came out and had analysis. It appeared to me, Tom Bailey, the banks that got TARP took big write-offs. The banks who didn't did the analysis and came up with a number. All the accountants signed off on them. But here is where I see the taxpayers, and you are footing the bill for the uncertainty in this rule.
Well, I think there is opportunity out in the marketplace if there was an ability for investors to understand the actual condition of a lot of these institutions and maybe a lot of these securities. I'm told that there are ways to dig down into those portfolios and actually determine those. But what those people also tell me is that that is the assumption that this is as worse as it gets. And that this, where we saw in the headlines today, is that foreclosures actually increased in the month of February, and Freddie and Fannie actually had a moratorium on foreclosures. And so what we do know is the universe isn't static and that things are getting worse. I think one of the questions I have to the panel in the short period of time I have left is if you could use a market evaluation process that everybody uses, but use a disclosure model, box or a addendum that says this is the assets we hold. We're currently valuing these assets internally based on this. Now, this is the way we have to disclose them. But if on your balance sheet you disclosed how many you have, what your default rate is, what your projected cash flow was on the security when you bought it, what it is today, obviously the industry could develop some standards. If that was in your footnotes, then I think possibly that would bring some transparency to the marketplace where I could then make a decision whether to invest in your bank or Mr. Cotton's bank or somebody else's bank. Would the panel respond to a suggestion like that, Mr. Mahoney?
Thank you, Congressman. Fair value by itself isn't sufficient. There needs to be robust disclosures around fair value. So an idea along your lines, we'd certainly be supportive of. The white paper that I attached to my testimony does include a recommendation about some additional disclosures, particularly with respect to the hard-to-value assets. So that'd be something that the investor community would be very supportive of, to have more robust disclosures around both impairments as well as mark-to-market or other changes in fair value. Thank you.
Okay. Yes, Congressman, I would note that the Securities and Exchange Commission currently allows that type of disclosure, not in the footnotes to the financial statements, but in the management discussion and analysis. So there's nothing to prevent management from making those kinds of disclosures about the assumptions that they're making, about their cash flow predictions. And in fact, one of the recommendations that the Center for Audit Quality made in its November comment letter was to have the SEC to give even more clarity around that so that people are comfortable using that mechanism of disclosure.
If I may.
Mr. Isaac.
Yeah, I'd like to respond to that. I think that, first of all, I'm all for all the disclosure anybody wants to make. The problem we have here is they're running these losses, these market losses, through the income statement, which scares the public when they see multi-billion-dollar losses being announced that aren't real. The public doesn't know they're not real, but they're not real. And they're disclosing, and they're running it through the capital account. And for every dollar that goes through that capital account, you're diminishing $10 of bank lending capacity. So I'm all for all the disclosures you want to make, but you don't run these mark-to-market losses through the income statement and balance sheet. That's the problem with this accounting system. And let me just take this, and what we do need is bank examiners and accountants in there with their sleeves rolled up, giving these assets a true economic value so we can all know what they are. But this in my chart here, we've got a bank that has a portfolio that it expects. This is one bank and one portfolio in that bank. They've taken nearly $1 billion of write-offs that don't need to be, because their belief is, their firm belief is, based on economic analysis, is that the losses in this portfolio will be zero. Worst case they can come up with is $100 million of loss. They've had to take a $913 million loss with this mark-to-market rule. And so we just destroyed $1 billion of capital in this bank needlessly, which is $10 billion of lending. And that's just one portfolio in one bank. So the problem is we're destroying capital, and we're taking it out of earnings, and we're scaring the public and making them think this problem is worse than it is.
Thank you very much, Mr. Neugebauer. And Ms. Kapler of Ohio.
Thank you. Mr. Chairman, again, my compliments to you for a great hearing and one for the nation. I hope that some individuals over at the White House and at Treasury will be influenced by what is said here today, because they need to hear this. Mr. Isaac, you are uniquely qualified. I appreciate all the witnesses being here, but I don't know too many living Americans who've been involved in resolving over 3,000 insolvent institutions and who have served presidents, both Democratic and Republican presidents, and who have a track record that demonstrates they know what they're doing, and they have a written record existing over 35 years of solid and sound financial advice. I'm going to ask a question and then make a reference to something else while you're thinking of the answer. But if President Obama were in this room and you were to advise him what to do in order to begin addressing this situation, I know you know the answer to that, but while you're thinking of how you want to order that answer, let me just say that it is amazing to me as a citizen of our country that the housing market is the proximate cause of this downturn, and yet we seem uniquely unable to get our arms around that with all of the brilliant people that we've heard from this morning. And I don't know if it's partly a political problem of people being afraid of what happened with Enron and being gun-shy, or afraid with what's happened with AIG, and therefore, we don't want to be politically perceived as doing something that is irresponsible. But we all have to figure this out together, and the lack of our ability to do that has created situations in places like I live where credit is totally seized up, where our auto dealers cannot get loans from banks, where I am our region is one of the 3 leading solar centers in the hemisphere. We cannot get loans to hire people right now to bring up our factory floors to meet orders that are pending all over the world. The banks can't make the loans. I see people being laid off in my region, and I'm saying, why can't all these brilliant people in Washington get their act together? And I look at the Treasury. Secretary Geithner was up here this week. We met with President Obama yesterday on the whole budget problem. Why can't we get together on this? What is hampering our ability to do that? I leave that question hanging out there. Is this a sad condition of our age where we've become so individualistic and our agencies have become so stovepiped that we can't seem to do this together? Is it something that's really fundamentally wrong? But somehow we have to pull together here. And Mr. Isaac, if President Obama or Michelle is listening, how you served other presidents. You served President Carter, you served President Reagan, presidents who actually accomplished something when they were in office. What could you add? What could you say to the president?
Thank you. I guess I would have a few things I'd say, and one is that the SEC needs to be brought into the solution here. They shouldn't be out on the side, sitting on their hands the way they have been. And so I would, if I were advising President Obama, I would say, get the chairman of the SEC into your office and tell them that they're going to deal with the uptick rule, and they're going to control the short selling activity, and tell them they're going to reform this mark to market so that it really is not so destructive of the capital in the banking system. The second thing I would say is we need to get the securitization markets working again. The Fed has a program they've started, and I think they need to go faster on that, and they need to do more. They need to do more and faster. They got to get on it because we really need to get securitizations going again. I'd make it more clear than we have that the U.S. stands behind its banking system. We're not going to nationalize the banks, but we are going to do whatever it takes to right this system and make it work. Because if we don't get the banks working right, the rest of it isn't going to work. So we really have to start there and get that fixed. And mark to market is an important part of that. The restrictions on short sellers is an important part of that. I think he's announced a housing program. I support it. I think we need to help people who are losing their homes, and we need to stabilize the housing markets. And then finally, something I feel, he ran on a message of hope and optimism, and I think he needs to get that message out there. He forgot it after the election for a while, and I think it's time to see. I mean, Franklin Roosevelt did it. He said the only thing we have to fear is fear itself. Ronald Reagan said it's morning in America again, and we need hope, and we need an optimistic president, and we need optimistic congressional leaders, in my opinion, who can give somebody a reason to go out and buy a new car or a new washing machine. Right now, people are scared. We really have scared the public, so those are my thoughts.
Thank you.
Thank you very much, Ms. Captain.
I'm optimistic. I'm going to buy a new car, actually. I might get a good deal. At the end of this, if someone give me a list of the accomplishments during the Carter administration, I'll be looking for that. Some technical things. Can someone talk to me?
I hope the gentleman will yield on that point.
Well, when I'm done here.
I think Egypt can help answer that question for one.
With regard to OTTI, help me out understand some of the stuff with regard to that. The trigger right now is what? Basically a dollar diminution in value that you see as far as being, as opposed to some other proposals that are out there saying that it shouldn't be that, but should be a material diminution as a trigger? As with regard to whether the impairment is? No? Okay. Second question. Ms. Farnelli, you know where I'm going on this?
Well, as you know, I'm not a CPA, but we can get that answer to you.
Okay, great. Second question then is with regard to gains. And I think someone else from the panel talked about this before, and I think the first panel did as well, and how it should work. Whether or not you permit a gain in the, or other positive adjustment in the valuation of it, which you don't occur right now. In other words, normally I think I've discussed it with some of you before, and some of the balance, it just ticks down, but if it's in the accounts that are held for long term, you don't see that tick back up again. Mr. Isaac?
I think that's right. I think you mark down, and the only way you get that value back is to sell it.
Sell it.
And a lot of banks don't really want to sell it because they're good yielding investments. They want to hold them, but they're stuck.
Right. So what do we need to do about that, or should we do? I should put it. Should we be doing anything about that?
I think what really needs to be done is, as I understand it, and I'm not an accountant and don't aspire to be one, but as I understand it, the OTTI problem is that you've got two kinds of things that are causing us to mark down based on other than temporary impairment. One is the potential for credit loss there, And I wouldn't argue with that. If you have credit losses, you ought to mark it down, or anticipated credit losses. That ought to be marked down, and I don't think that's controversial. The issue is we're marking down for market swings as well, and that's highly destructive.
But going forward, if you have, if you're holding and there's and you actually see an appreciation of that, right now, as you said before, you can't
mark it up.
Can't mark it up. You can't.
Is my understanding.
Right. And there might be a benefit to that, would there not be?
There would be, but it'd be better not to mark it down at all, and,
Right.
and for market moves, and just mark down the credit losses or the anticipated credit losses.
Sir, I have been told by a banker that if you've been too pessimistic in marking them down, you're not allowed to put it back when it turns out that you're wrong. But I've also been told that the regulators have the authority already to change that, but they're somewhat reluctant to use that authority because there's some provision that says if they use that authority and do that, they have to report back to Congress that they have done it, and they're reluctant to do that. That's all I know.
And my understanding is that if they do bring it back, if the regulators allow it to come back, they bring it back, they accrete it over time, whereas the hit's taken all at once. And so the best thing to do is not to do it.
I understand the best, and we're trying to get there. I'm just trying to think what else may do. And the next question may go to Mr. Cotton or other people. You talked at the beginning of your testimony with regard to the application that's going on right now, and I think we're all across the board in agreement on the application of the current rules is not what we would have them. I'm concerned even after 3 weeks from now or 4 weeks from now we get the new rules, whether or not they're going to be have enough clarity to actually get the application there. So I just appreciate your thoughts on that. But even if that does not occur, that we get to the point where we want to be on this, right? One of the other recommendations is that we deal with the financial institutions and deal with, as some of the members here have talked about, as far as the regulators, as far as having them basically solve the problem for us, right? That doesn't do it for you folks.
No, that doesn't. Most of the conversation this morning and actually at this table has been about banks. And I think there's a missing element here, and that's investors like I've been for the last 10 or 15 years. Investors who use other people's money through funds that they've raised. For instance, pensioners from Pennsylvania invested with me over the last 15 years.
Okay.
They are being harmed because we're unable to value these assets where we see them as valued. We, as the people who made the investment, did our work, did our analysis, understood the assets that were involved, and we have an opinion on value. We give that opinion to an accountant who says, well, that's interesting, but can you get me 3 bids from the street? Well, those 3 bids from the street bear no resemblance to the value. I said before in my comments that commercial mortgages today that are securitized have a very low delinquency rate. In the portfolio that I used to run, and I retired in December, but in that portfolio, it's maybe 1% delinquency. And the people who manage that portfolio understand what's in it and can present the data. They've got the cash flows, the rent rolls, they understand the assets. They can present that data. But if you don't go to the level 3, as it's called, in the guidance for the accountant, and have the accountant have the ability to understand what's involved in the asset, as Mr. Bailey said, he can look at the loan in his book and he can make a determination as he's going to get paid back or not and come to a value and take a credit impairment if it's appropriate. In our case, we looked at the portfolio and said, our portfolio has very little losses that we can see coming forward, yet when put to bid,
There's nothing.
The value goes through the floor. Commercial AAA CMBS today is trading at a dollar price of 65 cents. That would lead me to believe that the buyer thinks there's 35 cents loss in every bond at the AAA level. To get to a loss at a AAA level on a CMBS, you would need to have over 30% of the pool completely written off.
Nothing.
In an environment of 2% delinquencies, in an environment of 8% delinquencies, you are never going to get to 30% loss. However, the market has priced it there. Why? The buyer today is not the buyer who has traditionally bought those assets, particularly the buyer recently who is a buyer who says, I'm private, or I'm a hedge fund, or I'm some other vehicle that doesn't report mark-to-market, so I will take advantage of you who do report mark-to-market, and I'll give you a bid. And if you're desperate and you're forced to sell, you'll actually sell your bond, and I'll take advantage of that. So that 35% loss expectation at the AAA level on CMBS, which is so far from the reality, becomes the reality. That's the procyclical
For everybody,
nature.
for the regulator, thanks. Appreciate it.
Thank you very much, Mr. Garrett. Now we'll hear from the ranking member of the full committee, Mr. Baucus.
Thank you. Mr. Isaac, you were talking about market confidence and fear and optimism, and I agree totally with you. I actually issued a statement day before yesterday that said this: Warren Buffett's recent comments that markets are confused and fearful are right on point. Contributing to the current market confusion and fear is the constant stream of inconsistent, inaccurate, and exaggerated statements concerning our economy and financial institutions from both the administration and Congress. And I mean, everything from statements about our large financial institutions are all walking dead or zombies. I want to apologize to you. When you came to the Hill in July of last year and started talking about mark-to-market, quite frankly, I was on the other side. And but I did realize, I was hearing from bankers and insurance execs and everything else that it was causing real disruptions. And I knew that it was in valuation. But as a result, I did respond by putting into the October 3rd, when we passed the TARP bill, a thing to study it. And as soon as I did, folks came after me. Washington Post on the 20th. I'd like to. Well, first of all, the Financial Accounting Foundation, which is over the FASB, they wrote me a letter where they basically admonished me said that Congress ought to stay out of their business and not play politics with accounting standards, which I actually agree that we shouldn't play politics. But, you know, I read in January, Mr. McTeer, that you wrote about, you know, the Fed spending tremendous extraordinary efforts, hundreds of billions of dollars, and the Treasury, hundreds of billions of dollars, and the taxpayers and all the regulators, and yet, you know, FASB and SEC, which has the right to order them to do things or do it themselves, were just missing. They were missing in action. And I really thought that October 3rd provision that Roy Blunt and I put in there that said do a study, the Washington Post attacked me and said, you know, we don't know anything about counting, but we did know that it was causing distortion. And the SEC, the amazing thing to me, they came back with a report, and it said there are problems, there are distortions, it needs to be something done. So they agreed with much of what y'all said today, and it went. They referred it to FASB, and it was like the dead letter file. And you know, every day, American businesses struggle, American taxpayers, and there was just no sense of urgency. I believe really this hearing is a real driver towards that. And Mr. McTeer, I read your article in January and said, let's invite this. And so I appreciate your testimony. I've been following your blog. And I'm going to introduce his article, My Mark-to-Market Nightmare. I wish every member would read that. I read a statement at the start of the hearing that John Lewis wrote a national best-selling book. He and I are both from Alabama, where he said that, you know, one of the things about America is they confront and overcome challenges, but everybody's in the house together working hard. And FASB and SEC, they hadn't been here. You know, people of conscience, he said, coming together. And I think after today they will be. I'm optimistic. One thing that has troubled me more every day is this idea that adjusting, and I have a hard time, fair value accounting
means a willing buyer and a willing seller. You know, so we don't have that. So there is a difference between, I mean, and some of my staff disagrees with me, but there's a difference in that and mark-to-market, because you actually interfere with a bank or someone's decision. You know, they won't sell. Like, you know, I don't have to sell my house today. So, you know, I don't have to sell my car today. I don't have to take it to an auction tomorrow. You know, but really banks, they're being pushed into arbitrarily assuming there's a transaction. And I know, Mr. Mahoney, you represent some of the investor groups. But I want to remind you that I think what sometimes you talk about when you talk about investors are really speculators. Investors, most Americans are investors for the long haul. I mean, they have pension plans, they have 401ks, and they're really more affected by pricing this stuff down every day than by not. I mean, you know, yeah, people want to buy, they want to know what something's worth. But those are, you know, those are more active markets. So I think that the investors ought to get on the side of doing something about this, because I think they have a whole lot more to lose. I have a question for each of you, and I don't know. I think we're going to do a second round, and I'll actually ask questions. I've often criticized my members for making speeches instead of asking questions. So if we can have a second round.
You can take the question now if you'd like.
What? We'll do that. So I'll yield back, but I think that
You can take the question now if you'd like.
I'll take the first one. Mr. Cotton, the commercial mortgage-backed securities market uses a synthetic instrument and the CMBX index to find observable market prices. Your testimony indicates that the CMBX index has been trading at a price that suggests 99% default rates. Should accounting rules force CMBS market participants to mark to an inaccurate barometer of fair value, given the performance of CMBS loans? That's what we call a leading question in court.
Yes, sir. I feel led at this moment. I believe what was said in the testimony, and previous people from our organization have said it, there was a time that CMBX priced to a 99% loss expectation. I think if you heard what I said a minute ago, presently the cash bond is pricing, assuming that there's a loss in the AAA. Both of those don't bear a resemblance to the underlying performance of the assets, because the buyer and seller, particularly the buyer and seller of the index, he or she is trying to hedge a position one way or the other. They're making a bet. It's not a lot different than betting on a fly going up a wall, as I used to say when I lived in Australia. It's a gamble. The fundamentals don't bear any resemblance to either of those at this moment. And I think what we're talking about here is trying to get back to fundamentals.
Thank you. Mr. McTier, I read your blog where you advocate an approach that would split impaired assets into a credit loss component and a liquidity market component. How would this approach mitigate exaggerated hypothetical losses that could cause the collapse of a financial institution?
Well, I think it would mitigate it in the sense that it would limit the write-downs to write-downs that were justified by actual credit impairment. And if it's done well, it would not cause write-downs because of illiquidity and a cyclical market.
Yeah, I actually had an insurance executive that proposed the same thing that you did. I don't think he'd read your remarks. You hadn't read his, but he said it is important to make those distinctions. Ms. Better, is it? Is that pronounced right? In your experience, have you seen a reluctance by firms to value their assets using level 3 models because of concerns that those valuations would not be accepted by auditors? And if so, what can be done to encourage firms to use level 3 valuations with confidence?
Yes, your question is a common concern of people. The difficulty right now in going to level 3 accounting is that distressed market prices exist for some of the underlying instruments that are involved in the securitized securities. So, for example, there are some dealers who are still maintaining prices for residential mortgage securities about 3 cents for double B securities and up to 30 cents for double A's, which implies that 60% of the market is going to default. That being said, residential mortgages in many markets are happening at, or the value of sales are at 75 cents of where they were before. So the loss is maybe 25%. It's certainly not 60 cents or 70 cents on the dollar. The challenge is that in going to level 3, in marking to your own model, you have to justify often to the audit firms why you're not using that, quote, market of 3 cents or 30 cents underneath the instruments. And for that reason, this is why I'm saying the single measure is a failing. I think what the argument that Mr. Cotton is making and also that Mr. Isaac and Mr. McTeer have made is that firms have to be able to use judgment and they have to be able to use model prices that they're using that make sense. I think the concern on the part of the accountants and others is that how do you ensure that the assumptions that are going into those models are valid and that they're not pie in the sky in terms of assuming that all is well when all is not, and how do you get to the right number? And I think that if you put alongside the mark-to-market number, which I do not advocate throwing out, a mark-to-model number that the firms can use as they wish, but with some type of independent verification, that will give the market the information to do what it needs, and it won't force these unnecessary write-downs that are harming firms.
All right, thank you.
Thank you very much, Mr. Bacchus. And now we'll hear from Mr. Price.
Thank you, Mr. Chairman, and I want to thank the panelists for their tolerance and forbearance of our schedule today. Mr. Mahoney, you've been around this business for a good long time. You played any role with any other institution prior to coming with the Council of Institutional Investors?
Yes.
And what would that be?
I was a staff person at the Financial Accounting Standards Board. I was actually started off as a project manager involved in helping the development of accounting standards. Then after that, it was my job to talk about accounting standards and explain them to members of Congress and others.
So you worked at FASB?
Yes, I did. And I am now co-chair of an advisory committee of a group of investors who provide input into the FASB process. We try to collect the views of investors from across this country. We have a good cross-section of people on that group and try to explain to the FASB, and we disagree with the FASB a lot. If you look at my letters, you'll see we try to explain to the FASB what we think the best changes are for investors.
I'm glad you mentioned one of your letters, because a letter of October 29, 2008 states that you wrote that you believe that FASB's staff position issued on October 10, 2008 was largely responsive to the recommendation that was provided. Do you still believe that?
I'm sorry, that was which letter?
The letter of October 29th in your testimony, 2008, to Ms. Harmon at the SEC.
At the time, there was questions about the application of fair value accounting in illiquid markets, and they provided an example and some additional guidance as to how to apply that guidance, how to apply Statement 157 in a liquid market. It appears that there's still, as was said today, there's still problems out there about application.
Thanks. I'm going to try to stick to my 5 minutes, and
sure.
I appreciate that. Mr. Isaac, I share your anger. I want to thank you for your perspective. I want to thank you for the communication that you brought to our conference and to the Congress last fall. If we had followed your advice, we wouldn't be in the boat we're in right now. I want to ask you why you think that FASB and the SEC have not acted properly or promptly. What's driving them? What's their motivation?
I'm not a psychologist any more than I'm an accountant, but I'll give you my take on it. I believe that it's very difficult to admit when you've done something that didn't work out as badly as this thing is happening. You know, this has been a major loss of taxpayer money that's attributable, and great instability in the economy and the financial system, and it's hard to own up to that when you're an important part of the cause. I also think my impression is the accounting profession generally likes the fact that they can look at a computer screen and get a price off of that and not have to take any risk by actually getting in and valuing assets. They'd rather do it that way. It takes the heat off of them. And so those are my guesses, but
At some point, you got to quit digging, though, right?
I mean, it's time for us to. I believe it was Representative Bacchus who said it's time to all get in the house, or we've got a problem. We got to get together and we got to do whatever needs to be done to get it fixed. And I don't see how we do that without FASB and the SEC being part of the solution, or if they're not part of the solution, finding somebody else to do the job.
Right. Well, we're trying to push them in that direction, and we appreciate your input sincerely. Mr. Bailey, I hear my bankers are saying the same thing, that they are having huge problems. I wonder if you might share with us how the dialogue has changed that's different now than what it was prior to the crisis with the regulators between your banks and you. What's changed in that dialogue? Anything?
Could you clarify? I'm not sure what you're
asking. In
asking.
terms of their interaction with you, what they're talking with you about, what they're requiring of you, how strict they are, has that relationship changed at all?
It has slightly. In fact, on Monday I got a call from the FDIC. You file your quarterly report. They noticed the mark-to-market adjustment, the dialogue. They understood it. They have other banks. In fact, in the Northeast region, which is where I'm from, they said there are no credit issues, loan credit issues in Western Pennsylvania. They're investment issues. And when they first came in last summer and did an exam, it was, what's the market price? What's the market price? Now they're listening to the level 3 pricing.
So they're moving in a positive direction.
It appears. The staff person who called me, I don't know if the higher ups are in that.
Mr. Bailey, I want to follow up with you and Ms. Better. Each of you had very specific recommendations, and I wonder, my sense is that the SEC and FASB could institute a lot of those recommendations without any action by this committee. Do you believe that, and would you highlight the ones that you believe they could institute without legislative action?
Sure. I believe that the one thing they would have to do is clarify the definition between what's a liquid and an illiquid market, and when one might move away from the mark-to-market accounting. Mark-to-market is a fallacy when there is no market.
And they have the authority to do that right now, as I understand it. Is that correct?
I believe that they allow those calculations in the footnotes, and I think that what would help the market tremendously, though, is not to require just the sole mark-to-market measure in the accounting statements. That's also part of the problem that's fueling the difficulty in very highly liquid markets and in illiquid markets.
Great, thank you. My time's expired, Mr. Chairman. Thank you.
Thank you very much, Mr. Price. In saying, Mr. Isaac, I understand you have an appointment. You may have to leave because we've kept the panel so long. Certainly we'll understand if you have to leave, and feel free to do so whenever you have to. We have about 4 or more members that have some questions, and we'll try our friend from California, Mr. Sherman.
Thank you, Mr. Chairman. Mr. Isaac, before you leave, I couldn't agree with you more that there's a tendency of the FASB to design accounting standards so that whatever is being reported is verifiable, uncontestable, easy to determine, and impossible to sue about, rather than reflective of reality. And if baseball had been designed by umpires, and umpires faced not only video instant replay, but lawsuits, there wouldn't be a strike zone, because, like, you'd get sued every time. And you weren't here earlier necessarily hear me rail against FASB number 2, which has depressed investment in research, because if you do the accounting the right way, accountants have to look at which research programs were successful and which were not, and it's easier to simply assume that all are not. It's hard for Congress to get into the business of legislating generally accepted accounting principles, and that has always been a private sector function. But regulatory accounting principles have traditionally been a governmental function. If we were to modify mark-to-market for RAP while leaving GAAP the way it is. Would we, I realize that we might not be helping Citigroup share prices, but my goal is to just keep banks lending and keep the regulators from taking them over when they shouldn't. If we change RAP without changing GAAP, do we solve the problem?
Mr. Chairman, I think that's better than doing nothing, but I worry about it because if Gotham Bank reports a $30 billion loss because of mark-to-market accounting, it's a public, the holding company is a public company, and it reports a $30 billion loss, I think you've created a huge psychological and fear problem in the marketplace about that. And the regulator can say, well, that we don't care about that. We're going to count that $30 billion as part of capital. We're not going to make them write it off for regulatory purposes. It doesn't seem to me that does much to restore confidence. You'd have two parties arguing about what's the right value. It seems to me that one of the reasons why we were able to get through the 80s with those massive banking problems successfully is because somebody was in charge. We didn't turn it over to the marketplace and have it be a free-for-all. And by somebody in charge, I mean the bank regulators were in charge. They were in charge of the accounting. They were in charge of examining the books and deciding who had what amount of capital, what had to be written off. And the marketplace could say, well, we don't think the regulators are doing a good job or not, but there was somebody in charge. There was a way to determine values. And we maintained stability and order while we were failing 3,000 banks.
If I can interrupt, the other concern is, okay, mark-to-market marks things down too low.
Right.
Let's say we do away with mark-to-market. What is the risk that more traditional accounting methods fail to adequately reserve for doubtful accounts, and that we end up with an accounting statement that is not only that's simply too generous, even if on a hold-to-maturity basis?
Our experience during the 1980s was not that accountants and bank examiners were being too soft. We had the opposite fear, that accountants were being too cautious and bank examiners were being too cautious and were causing more write-downs than were necessary, and therefore we had more bank failures than we should have had. If that would be my assessment of the 80s, having been on duty, that if anything, the system was overly conservative, but it wasn't wild like today, where we're letting short sellers determine how much something's worth, and we're blindly accepting their evaluations.
And so we could believe my time has basically expired. Thank you very much.
Thank you very much, Mr. Chairman. And now, Mr. Manzullo.
Thank you. I recall in September, Mr. Isaac, we were in a room with Dennis Kucinich, and I think Marcy Kaptur was there, and a lot of other Democrats, a lot of Republicans, and we were pleading with Secretary Paulson, screaming at him. FDIC has the authority to insure any amount at any FDIC institution. Please do it immediately. He said, no. We want to buy these bad assets. And then you talked about your experience. Nope, we don't want to do that. You talked about exchanging a high-quality commercial paper for an infusion of capital. Nope, we don't want to do that. And we also obviously talked about FAS 157. And no one wanted to do anything. And I think here's the problem. I can quote from Mrs. Fornelli's statement. She says, the crisis has been caused by loan losses and runs on the bank, not fair value accounting. And then I quote from the man on the street over there, Mr. Bailey. He says, the application of mark-to-market in frozen markets is the heart of the problem. I mean, either mark-to-market is a problem or it's not a problem. And I see two planes of very honest, distinguished, dedicated people, and you're simply not connecting. But let me tell you where the connection comes in. Mark-to-marketing is destroying manufacturing in America. Let me say it again. Mark-to-marketing is destroying manufacturing in America. Let me say it 3 times. You don't know unless you're on the streets, and Mr. Bailey knows. You don't know what's happening to manufacturing in this country when they're barely holding on, with one regulation after the other coming from Washington, all types of new exotic products coming out of the White House. People who have had loans with the same institutions, the same amount of sales, the same collateral, are being told by their bankers that we can't give you any more money because of mark-to-marketing. Now, either I've got several hundred lawyers on my hands representing several hundred industries in the city of Rockford, which had 25% unemployment in 1980 and lost 100 factories and 10,000 highly skilled jobs. Or people think mark-to-marketing is some type of philosophy just hanging out there. And all I hear is we have to address this. We got to do this. And meanwhile, no one does a dang thing. Nothing is happening. I mean, can't you see how critical this is? If you don't understand mark-to-marketing, if all you do is argue about it, then throw the damn thing out. Excuse me. And put something else in place. But what's at stake are all these industries. I don't think you have any idea how fragile manufacturing is in this country. I mean, is mark-to-marketing a part of the problem or not? Mr. Bailey?
Yes, sir, it is.
Why is it a problem? You meet these people all the time, just like I do.
We heard the gentleman from Frasby this morning talk about that investments are only a small piece. Yet the FDIC reports $400 billion of assets are in these securities. $400 billion. If we take a conservative estimate the way things are right now and mark-to-market that, it wouldn't be unreasonable to take, say, 25% of that would be impaired. Okay, that's $100 billion. $100 billion hit in capital is $1 trillion in lending ability from banks.
Ms. Fernelli, is mark-to-marketing a cause of the problem here?
Mark-to-marketing, and I don't just think that the SEC found this, Chairman Bernanke, Treasury Secretary Geithner, did not cause the credit crisis that we're in, but certainly, as we've all heard today, and I think that we all agree, mark-to-market accounting needs to be improved.
No, I understand that, but no one has any exact things on how you're going to improve it. It's not working. Whatever you do, whatever guidance you give, it's not working. Things are locked.
But I think there are ways to improve it, and we've all put those out.
Well, the crisis came in September. This is now the middle of March. That's what this man was doing here, screaming with a bunch of members, and no one's done anything in 6 months.
Congressman, I think we've suggested, and I think I've heard some other people here, is more following FAS 114, which would be separate the credit from the market price.
Well, let's just get it done. I mean, why can't we just do it and move on? Value these assets honestly.
I'm sure it's in the control of the people sitting at this table.
Yeah.
Sorry to interrupt.
I understand. Is anybody here from the OCC or the SEC? Anybody here?
They were here
in the room?
morning.
No. Is anybody here in the room now to listen to this testimony?
They're on our side, yeah.
I don't see anybody there. Thank you.
Thank you very much, Mr. Manzella. Now our final on the Republican side, Mr. Royce.
Thank you, Mr. Chairman. I'd like to ask a question just about some of these assumptions that you read in the financial press, just to see, kind of weigh this assertion. And I suspected that Steve Forbes kicked this off with his argument that in the early 90s with the financial problems, that if we'd had mark-to-market virtually every major financial institution, would have been undercapitalized, and we would have had a crisis that he argues would have been on an order of the Depression in the 30s if it had really been deployed or enforced, and argued it was dropped in 38 partly for this reason in 1938, came back when fall of 2007 I guess is when FAS 157 was implemented. So he would argue that this has greatly compounded the problem. I'd just like to go to the assessment about the early 90s and just with a little reflection and thinking about some of the problems we faced then, what would have been the consequences?
I'd be happy to respond to that since I was there.
Mr. Isaac?
And it was really the 1980s more than the 90s. The 90s were a mop-up of the SNL.
Early 90s was what we remember, but yeah, the late 80s was
the 90s were the mop-up of the SNL problem. From 89 forward, we just mopped up the SNL problem. Prior to that is when we really had we were in really serious soup in the early and mid-80s. We had $200 billion of insolvency in the S&L industry and the savings bank industry if you had marked them to market. We didn't have to, but that's what you would have had, is $200 billion of insolvency. All of the money center banks were insolvent if you had marked their virtually all of them were insolvent if you had marked their third world debt portfolios to the then prevailing market prices. The markets had dried up and nobody wanted this stuff, just like today. There's no question that we would have failed thousands. We failed 3,000. We would have failed thousands of additional banks and thrifts during the 1980s and early 90s, including all of the money center banks. We had a standby plan to nationalize them if we had to, and we would have if we'd had to. And so it was a very, very serious time, and we couldn't have coped with it under today's mark-to-market rules. Just couldn't have coped with it.
Mr. Cotton, did you have commentary on that front?
Well, I was a borrower in the 80s, so I was probably on the guilty side of that equation at the time. But I think what Mr. Isaac is saying, and I think what you're hearing from all of us, is that if you are looking for an immediate answer from a screen, you'll get an easy answer, and that screen answer may not be anywhere near the reality. And we are advocating that the accountants be given the authority to do level 3 work and be encouraged to do level 3 work, and then they have to make a judgment. And I think they have to in some way be comforted that that judgment doesn't necessarily lead to a lawsuit. I thought the metaphor used earlier about the strike zone was an interesting one. Yeah. If the auditors are afraid of their shadows, it's easy to go to a screen and say, there's the price. But if the price is the wrong price because it's the easy price and that's where they go, I think we make this mistake and we exacerbate this.
Well, let me ask another question, because we've got another debate going on international financial reporting standards, and GAAP is very much rules-based, and we're tied to those rules. The Brits and others approach this from a little different vantage point, principles-based. Would going to IFRS standards lead us down a road that in some way gets us out of the box that we're in here? I don't know. So
I'm not an accountant, so if you're asking me that question,
all right,
it missed me.
My concern about that, the international rules are actually better than ours on OTTI, is my understanding. But my fear of going to the international rules is if we think FASB and the SEC are slow, bureaucratic, and lethargic, you ain't seen nothing yet. I'm scared to death of going to subjecting ourselves to an international standard. This hearing today would be irrelevant if you had international standards, because you couldn't do anything about it. So I really think that that's a dangerous thing, and the SEC is headed down that path, and I think we ought to get them off that path.
Going back to my original point, I'll have Mr. Bailey give me your assessment.
You want to do the second round?
Last question, then. Your assessment, going back to the late 80s. What's your perspective now, just thinking about that? We've got the figure there, 200 billion insolvency in the financial assessment there. What would you think?
I was just coming into the industry at that time, so I couldn't comment. I'm sorry.
Okay. Well, anyway, my time's expired, Mr. Chairman. Thank you very much.
Thank you very much, Mr. Rice. We have a request for a second round. Does anybody want to indicate what they're in favor of there at the table? But I haven't had my round, so I'm going to take at least a portion of my round. Look, Mr. Manzola was somewhat threatening to the table, but to my knowledge, none of you are presently regulators or involved in any of the standard settings.
Mr. Chairman, I owe an apology to the frustration level is extraordinarily high.
I appreciate that.
And I thank you for your indulgence.
I just wanted to make sure that they didn't go home for the weekend and feel really under the weather because of that. No, the reality is, it brought something up to me that this hearing really represents to me in some of our problems that we've been discussing today and some of our responses to those problems. We had our first hearing at this committee, not as a committee hearing this year, on January 5th. The reason that, and that was the Madoff scandal that occurred over Christmas. And our first opportunity to get to the Madoff scandal was January 5th, and some of the members may recall that. But it had to be a meeting of the committee and not a hearing because we had not formally met in the new Congress, since the new Congress didn't take its oath of office until January 6th, and therefore we were not an organized committee of the House and couldn't proceed that way. Some of us tend to be formal that way. Others would like to say, damn, it's still the same problem. We're the same people. Let's get at it. And I think that's the frustration that I'm hearing from a lot of the members here at the meeting and from the panel, that we're sick and tired and we're not going to take it anymore, and that we don't care for perfection or idealism. We really want to get the job done. And I think the message, I hope the message went out to our earlier panel, and I know they're watching this in that secret room that we set up. Maybe they've resolved this whole problem already for it. But I hope they are watching this, or they're talking about what may have transpired here this afternoon. Because we expect those three gentlemen representing three distinct agencies of the United States government to show the American people, show the street, and show everybody else that they can function. And I was very serious when I told them, as soon as we get back from the Easter break, which will be more than 3 weeks, we can't meet exactly on the third week because we'll be out of session in the Congress and not available. But we will have a hearing, if we're not notified in the meantime, that there's a change of the rule. I think we ought to pursue these matters this way and sometimes stretch the practicality of what we can do and sometimes stretch the rules. These are extraordinary times. I think sometimes some of us in government and in leadership have failed to impart the importance of our economic distress to the American people. I've been going about doing that as much as I can, not only in my district, but on a national level, because if we don't have the import and the importance of the problem, we'll not direct our attention adequately to the problem. It's probably the most serious economic problem in my lifetime that I can think of. And since I'm older than anybody sitting in that panel, I would conclude it's the worst of any of your problems. Now, I like where this hearing went today, and that's why I really want to compliment my friends on the Republican side as well as all my friends on the Democratic side that are here, that we really had a coming together. And that coming together occurred because we are starting to begin to recognize a very important factor. We're only going to survive as a country and as an economy if we do realize how important this problem is, and that we use all our imagination to address it as clearly as possible. And I think that may have started today, and I want to compliment my friends on the Republican side, because if it didn't start today, I want it to start tomorrow. But I think it may have. And it's important that we continue this process, not only the next hearing on mark-to-market, but so many other hearings that we're going to have on reforming regulation and doing so many other things that were scheduled. I intend to schedule as many hearings as physically and humanly possible, and we have one limitation. We don't have enough hearing rooms. But if we could, we would appropriate sufficient amount of money to double the house size so we could have that. But unfortunately, that couldn't be completed for at least 8 to 10 years. Maybe with the architects of the Capitol, it would take 20 to 30 years. That being the problem, where unfortunately we'll have to meet at the curbside. And that may be the best place to meet, particularly if it's cold enough in the winter in Pennsylvania. We'll get some action done very quickly, because it usually works that way in Pennsylvania. We'll stay out of Florida, because all of us love to go down there and spend the whole damn day at the curbside. That all being said, look, we're going to attend to this. We appreciate each and every one of your contributions. As I heard your contributions today, you've all had little unique things to say of how this could be approached. Your first situation was maybe we do it on the regulatory capital side, a hell of a lot easier than doing it on the accounting side. And I seem to sympathize with that. But the answer to that, or your action using your experience, Mr. Isaac, on the other side, that you've had that experience, or our people on our side have had that experience, and we had to call upon them. That's why you're here. And we did listen to Marcy Kaptur. She said, you want an expert in this field, go get Isaac. That's why you're here. And all of the rest of you represent so much of the best and the brightest and the ablest. And I'm proud of you because you gave honest responses in your testimony as to what we should do. You're going to make it a little easier for us to proceed. But proceed we will, and proceed we shall. And I dare say, I don't know whether we're going to have an effect on the market, but the last reports we had on the Dow was significantly up to, it closed, is that it? At 239.66, the third day in a row. That's pretty good. Even if we didn't have anything to do with it, and I doubt we did, it's going to give everybody a nice weekend, 3 days up positive on the Dow. And I want to close with that. We can sit around here and condemn every practice and every idea and everybody's judgment, including the accountants. And damn, sometimes they make tough judgments that are hard to compliment. But the reality is that we can change the economy of the United States if we just start getting positive, if we just start realizing that we can do it. We may go home tonight and wake up tomorrow, and as we're preparing to shave, and I don't know what the equivalent is on the feminine side, but whatever it is, you'll see the enemy very early in the morning. It'll be in that mirror that you're looking at. We are the enemy if that's what it is. And it's what we can do individually and collectively that can move this system along. I urge you to join this. And in spite of all the comments about Republicans and Democrats fighting and a tough political system, that's malarkey too. I firmly believe that this Congress is going to come together, the Senate's going to come together, and the Congress is going to come together with the President. We're going to lick this problem and solve this problem. But it's going to start with the contributions of folks like yourself that stayed here this late into the evening to help us get some idea of what this is all about. So I thank you for doing so. And before we adjourn, I have to make some statements for the record. The chair notes that some members may have additional questions for this panel, which they may submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to these witnesses and place their responses in the record. Before we adjourn, the following will be made part of the record of this hearing: questions submitted by Congresswoman Giffords and the written statements of, and this is one hell of a long set of written statements, the Mortgage Bankers Association, the Group of North American Insurance Enterprises, the American Bankers Association, the Council of Federal Home Loan Banks, the National Alliance of Community Economic Development Associations, and other signatories, the American Council of Life Insurers, the United States Chamber of Commerce, the National...
That's all one letter.
That's all it is.
Yeah, it's just one. Their letter.
No, each individual is a statement.
Oh, is it? They...
Yeah. The National Association
put one together.
of Federal Credit Unions, the Credit Union National Association, and without objection, it is so ordered that they're entered. And we only had them enter individual comments like that so we could keep hiring printers to keep the economy going. So you understand that. I know in Alabama that you wouldn't necessarily know that, Ms. Spencer. But anyway, this panel is presently dismissed, and this hearing is... Oh,
if you'll dismiss them, but I have some more things to put in the record.
Oh,
But
absolutely.
Go ahead and let them leave.
If the panel wishes to leave, they're free to leave. Mr. Bacchus?
Mr. Chairman,
entertain any motions.
I've got, there are at least 6 recommendations that FASB and the SEC and the bank regulators have identified specific proposals. I'd like to introduce a document outlining, these are things that they've already said need to be done. Okay.
Without objection, so ordered.
Second, I'd like to introduce the testimony of Chairman Bernanke, where he said that accounting standards were causing valuation and distortions and loss, impacting loss provisioning, and also that it was discouraging lending and it had restrained lending, which was the same thing that some of our members said, and that was
without objection.
And the
so ordered.
pro-cyclicality in the regulatory system. Mr. McTeer's My Mark-to-Market Nightmare, dated January the 11th. And basically what we have here is that we've set on our, October 3rd, I first put this in the bill and asked SEC to study it. It wasn't until February the 18th that FASB even announced they were going forward with a study, and that's about $1.5 trillion of taxpayers' money in the gap. So I'd introduce his article. Steve Forbes' bad accounting rules are the cause of the banking crisis. When Mr. Isaac said it in July, and I don't agree with this. By the way, I don't think they're the cause. I believe that they've contributed to there not being a recovery. And I know Ms. Fornelli, you know, she was asked by the member, do you think it caused it? And I think you and I agree it didn't cause it, but it sure has inhibited some of the interpretations has certainly inhibited a recovery.
And I do think that some of the things that this panel talked about, that were both in our testimony and on the panel, the FASB guidance that this subcommittee demanded of FASB in the next 3 weeks, as well as the other than temporary impairment improvements, and that does need to happen, and so we stand by that as well. I think those will make immense improvements to the application and the regulatory.
I agree. I'd like to introduce the Washington Post article talking about where we introduced it, put it in the bill, and also where it was titled "Don't Blame Mark-to-Market Accounting." It's been they actually talk about the bank regulators say it's not a problem, but obviously it is now, and they now all acknowledge it, including Comptroller Dugan. My statement on unreasonable criticism has created an atmosphere of fear and confusion. John Lewis, Congressman Lewis, I'd like to introduce the 2 pages of his book, Walking in the Wind, which I think ought to be a model for every member as we approach this problem. And finally, a letter that Roy Blunt and I wrote to the Chairman, Mary Shapiro, and very similar to what Chairman Barney Frank and Chairman Chris Dodd have also written similar letters. So with that, I'd like that they be introduced into the record. But I think where we start is where FASB and SEC have already acknowledged in their study that these are problems and things that need to be fixed, and where the bank regulators, including Chairman Bernanke, they've made specific recommendations for changes. Seems like those ought to be a given. Thank you, Mr. Chairman.
Without objection, all of the documents suggested by Mr. Bacchus are entered in the record. Anything else good for the order? Mr. Garrett, would you have a statement that you'd like to make?
I do have one other one. Yep. The October letter from the Financial Accounting Foundation.
Without objection, it's entered.
They really admonished us for trying to interfere with FASB.
Right.
Thank you.
It's entered. And now I'm not even going to ask the question again. The hearing is adjourned.
Have a good weekend.
Good one, Fred.